Oyez, oyez, oyez. Anyone having business before the King's Justice of the Superior Court of Justice, attend now and you shall be heard. The Honorable Madam Justice Hennessy presiding. Long live the King. You may be seated.
Good morning, all. Good morning,
Morning.
Mr. Schachter. For those of you who have been lamenting the end of winter, it has returned.
If the court is ready, I would
Ready to go.
propose.
I should have before me the slides.
You should have before you the slides, but before we get to the witness, there is a housekeeping matter that came up yesterday.
Okay.
I learned that there are a number of work papers, specifically the Stiglitz-Hutchings work papers and some of Ontario's work papers for sure, and maybe something from Canada, we're not sure, didn't make it into the joint book of documents. And all counsel agree that such documents should be part of the record. And the suggestion was made that the Stiglitz-Hutchings work papers, which are something like 900 pages, I'm told, could be put in the electronic record as Exhibit 1A, and then Ontario and Canada could put theirs in as 1B and 1C, or if you wanted to just wait, we could just get everybody's in as 1A. I'm not sure procedurally what the court thinks best on how to deal with it. I would like, Mr. Stiglitz and Hutchings work papers to go in while this witness is on direct, because this might be the last chance. Technically, I have to put them into evidence.
As amongst you, have you thought what works best? My own thought is the fewer exhibits, the better. And the exhibit could be described as a composite exhibit of additional work papers of the parties and then identified. But my next question is, do you think this is the last discovery you'll make?
No, I don't.
Okay.
I expect people are going to find that stuff is
Right.
missing.
So in which case, maybe an important part of the description might be the date.
Mhm.
Or the other, I'm just, thinking on my feet, and I'll be happy to hear what others say. Maybe you want to allow Canada and Ontario to put in their discovered work papers as they have witnesses on the stand.
I'm amenable to anything that works for my friends in the court. I'm amenable to just one exhibit, 1A. I'm amenable to Stiglitz and Hutchings, the work papers being 1A. And then putting them in through their witnesses later, it probably makes the most sense to me, actually.
Right, because you say you'll put yours in while you have your witness on the stand. And then, especially if there are later discoveries, same thing for Ontario, they can put them in when they put their witnesses on in Canada.
And they might change their work papers, right?
And I suppose it's a nice way to be able to look things up if they're identified by party.
Yeah.
Does that suit you, Mr. Marcello?
That works, Your Honor. I mean, there may be work papers that go in that aren't put to a witness, but I think the idea is to get them all in there. And so
Right.
why doesn't my friend just put the ones he's concerned about in today, and we'll do a B and C
And
later.
right. And then as it comes up, if and when you have work papers. Okay, thank you. And Ms. Evans, are you content with that?
Yes,
Okay, so we'll just file the plaintiff's
The
additional
Stiglitz
work
and
papers
the
today.
Stiglitz and Hutchings work papers would be Exhibit 1A. I understand they're electronic. I don't know how they go from Miss Lewis's computer to the court. I don't know how it. Okay.
Right, and I'm not sure whether it's the registrar or counsel who are uploading into the exhibits bundle on case lines.
I am.
There you go. So the exhibits will be in two places. One, an electronic copy with the court, And secondly, within the case line system in the exhibits bundle.
Okay.
All right, and we are calling it 1A?
Yes,
And
that
it
would be
will
the Stiglitz
called-
Hutchings work papers. Those were prepared by you, Mr. Hutchings. You're still under oath?
Yes.
Oh.
Yeah.
It also includes in the Hutchings main report and the Hutchings reply work papers. It's all the work papers for both Stiglitz and Hutchings.
Yes.
It's all of them.
Yeah.
Oh, okay. Very good.
The next thing, so if that's marked as an exhibit, the next thing that I would propose to do is hand up a new document that was I'd like to give to the court, and I've given a copy to my friends last night electronically and hard copy today. And Mr. Hutchings, these slides were prepared by you,
That's correct.
and you can attest to their accuracy.
Yes.
And I understand that the first one's identified as updated NCRR results. That's the first page. And on the bottom right-hand side, there's numbers 259.1, 259.2, and 313.1. Can you explain what those numbers are?
Sure. That's kind of where I would meant these slides to be inserted in the main slide deck, if you will. So
And can we,
259.1 comes after 259. Not to screw up the page numbering because we've had them all printed.
Right.
okay,
And my
so
thought,
that's to exhibit F?
well, no, I was thinking that I would mark it as Exhibit G since Exhibit F has already been marked.
Yes, I'm just saying they are the pages that
Oh,
would
yes.
otherwise
Yes,
be
I'm sorry,
referable
yes.
to exhibit F.
Yes.
Okay, thank you.
And so if we could have this marked as Exhibit G for now, and I will later, at the end of Mr. Hutchings' testimony, be making a submission in respective marking exhibits F and G as numbered exhibits, but that's to come. But first,
Okay,
on Exhibit G, Mr. Hutchings, can you explain what happened and why these have appeared today?
Sure. In reviewing my work papers again during the intervening days from when I was last here and preparing to testify, I identified an attribution error in forestry revenues that I had included for 3 years, a specific line item that I should not have been included. It was an oversight on my part. Specifically, a line item that shows up on reimbursements of expenditures from the federal government to Ontario. So that shows up as a revenue to Ontario
It shows up where in the
public accounts of Ontario. It's a revenue to Ontario, but because it's coming from the federal government, it's not really a direct Crown resource revenue. And generally, I exclude these. This one for these 3 years, I did not. So I wanted to make that correction and remove these 3 line items. I include here on slide 259.1 the impact that this has on the RST in each of these 3 years. It's about 324,000 in 1992, 98,000 in 1993, and 301,000 in 1994. Over the page 259.2, I prepare an updated, what does this mean on the totals, both in nominal terms and present value terms. If we added up those numbers on the prior slide, so little on about 700,000. And so you see that reflected as a reduction of, it shows up here as a million because it's rounded from 1.044 billion to 1.043 billion. And that's a change I express at the bottom there of 0.047%. What does that mean? That means it's a 5% of 1% change. And the other columns update at the different present value factors. Those impacts are relatively smaller because this was a change in the 1990s. And so the importance of compound interest is diminished.
All right, and we will get to slide 313.1 when we get to slide 313, I think.
That would be my plan, yes.
So with that correction, thank you, Mr. Hutchings. Is there anything more you wanted to say about that correction?
No.
Okay,
I felt once I identified it, I should bring it to everyone's attention.
okay. We turn then to an explanation about economic rents. The court and everyone will remember that Professor Stiglitz we marked it as exhibit G. No, all three of them are exhibit G. Thank you, Council.
We just need a moment.
No, just.
Thank you.
Council,
Ready.
you just said return to an explanation of economic rents.
Yes,
Or wants everyone to remember that Professor Stiglitz.
Professor Stiglitz had explained why economic rents was important for this court case. And he didn't do the calculation of what the economic rents. He said the figure is about 3.58 billion nominally, but he did not explain how he got to that number or how the two of you got to that number in your joint report. So the next part of your evidence is going to be about explaining how you got there. So the heading is economic rents, and the next slide is estimating economic rents. And I guess we start at slide 262.
Yes. So I said last Monday when I started testifying that I had three things to talk about. And we've talked about NCRRs. And now we're reaching the second part, which is economic rents. And as you said, Professor Stiglitz laid out, I guess 2 weeks ago now, the framework of what is an economic rent and in principle, how one should calculate it. And today I'm going to talk about how I did that calculation for each of the relevant resources in the RST to come up to that 3.58 billion nominal number. So before we get started, there are 5 resources, the same 5 resources I looked at net ground resource revenues for. That's mining, forestry, hydroelectricity, land, and spectrum. I'm on slide 262.
Thank you.
And for each of those, I'll talk about the method. So mining and forestry are done similarly. So I'll talk about them together. Then I'll talk about hydro. Then I'll talk about land. And finally, spectrum. Just a couple of notes here at the beginning, reiterating, I think, what Professor Stiglitz said 2 weeks ago. Doing this over 170 years, 5 different resources, there's not always the data you would like in a perfect world. And so when those data don't exist, or I don't think they're reliable enough for the calculation, I default to using the actual direct Crown resource revenues, which is about 40% of the time and is necessarily an understatement.
40% of the data, when you say 40% of the time or 40% of the years, or
40% of the resource years. So if you think for each of these 5, they exist for some number of that 170 years. If you multiply those two things together, 40% of those. Does that make sense? Because hydroelectricity, for example, wasn't a big thing for the first 70 years. So there's only maybe 100 years of hydro data. And another general thing is to make the calculations, I think, a little easier relative to doing it over this time period. I look at the excess profits or the rents that end up accruing to the producers in higher corporate profits. I don't try to disentangle the extent to which labor or other input suppliers received a portion of those rents. So again, if we're thinking about that pie Professor Stiglitz had, we're not looking at all the pieces of the pie. And I have that picture coming in a little bit to make this a little clearer. And in 40% of the time, we're only looking at that little red sliver. Just to note that at the outset, that this is going to lead to an estimate that is lower than the true value.
An estimate of what?
An estimate of rents.
Okay.
Sorry. In RST from 1850 to 2019.
Thank you.
So I'll start by talking about mining and forestry. And on slide 264, we have this picture that Professor Stiglitz used to explain that the whole height of that bar is be called gross output or total revenue. This is the idea of the price of ore times all the ore taken out. The total revenue you'd get from a resource. Where does it go? Some portion pays the labor. That's the bar in blue at the bottom. Some portion, you have to use to pay your suppliers. Maybe you need a truck. Maybe you need some tools. Maybe you need a lawyer. Those go in the teal box in the middle. And then, to run that operation, you had to get capital from investors or lenders, and they need to be paid a competitive return. So if each of those 3, labor, suppliers, and capital, are paid their competitive return, what's left over is the rent. That's the gold part at the top, as Professor Stiglitz explained. The value of the resource less the costs necessary to produce it. And that's what would normally accrue to the landowner. So that's what I'm going to talk about, how to estimate that.
can
Yeah.
I just ask this question?
Sure.
It's the value of the resource less what it costs to produce it.
Yes.
And the point of dispute as between you and other economists is how to define value.
I think on this point, it's more if this is, you could say it's how to define value.
Because otherwise the operation is the same.
Yes, they don't go through a rent calculation taking out the private costs of production. I think the dispute there is more, is rents a relevant framework to use rather than the mechanics of the calculation. I think our point of departure there is a little earlier of should we be trying to measure the value of the resource, to whomever owns it, rather than the narrower definition we talked about earlier, which is the value from direct Crown resource revenues. So the equation balancing, I think our dispute there is whether we should include everything, like the true value from the rent, or whether it's just, I think Professor Stiglitz had a version of this that had the red sliver at the top of the portion of the rent that's collected from direct Crown resource revenues. Because in practice, where does this rent go? Part of it goes to the Crown through direct Crown resource revenues, your stumpage charges, your acreage taxes. That I think we have agreement on as between the two sides. But another part of that rent goes to the crown through indirect means like the income taxes, etc. Another portion of that rent can end up in the hands of private parties through making more than competitive profits through implicit subsidies, etc. I think it's about how much of that gold bar is relevant. I think rather than I think there are some critiques of the mechanics of my calculation, but I think the point of departure is a little earlier about, is it relevant to measure the yellow box?
Thank you.
Is that helpful?
Yes.
So now on slide 265, I will present a formula using as many words as possible rather than numbers. So how do we estimate the rents? I start with a pretty straightforward approach of saying rents are approximately the excess profits earned by the firms engaged in the resource extraction activity. So as mentioned earlier, I'm not going to attempt to calculate what portion of the labor costs might reflect a sharing of rents. You know, if someone was paid $16 an hour instead of $15 an hour, I don't engage in that exercise. So, and that's why it's two tildes. I forget the exact name of that symbol, but rents are approximately excess profit.
So the wavy equal signs is wavy because it's an approximate, not exact.
Exactly. The wavy equal sign is the better way to put that. And I calculate excess profit as the revenues. And again, here it's revenues as a gross output measure, not direct crown revenues, but revenues from the operation of a mine, less the costs of all those inputs that we talked about on the prior slide. So there's labor and other intermediate inputs. Then there's depreciation, because as a machine wears out, it may have to be invested in to maintain. And part of the capital that's been invested in the business will be consumed. And so that has to be subtracted out from the revenues. If we're estimating real profits, depreciation, while it's an accounting approximation, it is approximating a real cost that your truck wears out. And the return on invested capital. So all the capital that has been invested to fund the capital assets each year has to be compensated a competitive return. So these four values together add up to the components on the prior slide of those blue, teal, and green bars. What's left over is the excess profit. The point at the bottom is more of a mechanical point about we can calculate this excess profit as a percent of output and then multiply it by output to get back our approximation of rents. That's just because, as I'll get into in a little bit, there are many different data sets. Things aren't always defined consistently. So we need some way to move back and forth. But the point at the bottom is more a mechanical point. Yeah,
I
And that
wonder, Mr.
asterisk
Hutchings.
is a multiplication sign.
that's right. Sorry.
Yeah. Mr. Hutchings, I wonder if you could give the court a sense as to how standard or unusual what you're doing is in economics is. Do we, as an economist, do you see this work in other fields or in other, not other fields, in other work that you do?
Yes.
Can you explain it, please?
Sure. So I've called it excess profits here. Sometimes in economics, it might be called pure profits or economic profits, which are profits above the competitive return to all the component parts. More recently, some texts may call it EVA, which is economic value add. Again, trying to measure how much profit or value is captured above a baseline, if you will, of paying everybody. People might undertake this for a number of different purposes. Maybe you want to estimate, how much value did you add to a business? A little bit like Professor Stiglitz spoke about the returns to pension funds. They might be high, but they also have benchmark returns because saying you earned 10%, you don't know if that's a good or bad result unless you compare it to something. If you earned 10% when the market earned 7%, good job. If you earned 10% when the market earned 12%, thumbs down. And same with economic value add or economic profits. It's not just how much accounting profit shows up at the end of the day. It's once you've paid all these people and a reasonable return, did you make more or less money? So how have I used it? Sometimes in analyses like that. We've also used it in cases on, say, competition matters.
So let me stop you. Say we've also
Oh,
used
sure.
it. Is this your particular company or economists generally?
Um,
Or both? maybe?
I think both. I think economists generally, people I work with, and me in particular, so I could speak into
Yeah.
have done this in cases involving competition or antitrust. Now you might say why?
I would ask that question.
Okay.
I was about to.
Sure. Well, economists like competition generally because it will lead to lower prices. If we're competing with each other, you should get an outcome such that we're each covering our costs and a reasonable profit, but not an extraordinary profit. If we're both selling coffee and you price it at $2.50 and I can sell it for $2, I will lower my price to get market share. That process will go on until we both get to a similar price. And we're just covering our costs. We should have an economic profit near zero. So I and others have used this as a sort of, check on anti-competitive behavior. So you might think of market as not competitive. If someone is engaging in anti-competitive behavior, that might manifest in higher profits, right? If Mr. Schachter if I'm not competing and he's charging $2.50 for coffee that would otherwise be $2, that will show up as him earning higher profits. So if you think something is going on, you can look at the profits earned in an industry, and if they seem stubbornly high, much higher than a competitive return, that can be a sign, and this is how we've used it in some competition cases, of maybe there's something going on. Why is somebody earning more than a competitive profit? It could be, again, anti-competitive. I just give that as an example. It could be you own a very valuable asset like a mine. There's only one mine. It's scarce. And so you'd expect that. So this is a theory that I think is pretty standard of calculating these pure profits, economic profits, excess profits, normal profits. I'll get different labels, but they're all basically saying the same thing of different from accounting profits, which is just your revenues minus your costs. You take out your capital costs as well. What does that look like? And that's a number that in well-functioning competitive markets will be close to zero. That's not to say you don't earn money. You earn money to pay your investors a competitive return, but not extra.
And so the analysis you're going to take us through is something you've done numerous times.
That's right. Okay. So looking at slide 266, we have the equation again with some color coding to match to the colorful bar chart. So the excess profit, which is our stand-in for rent, the gold bar, is revenues, which was Professor Stiglitz's gray bar, less labor and intermediate inputs, which are the blue and teal bars. And then these two components of capital, depreciation and return on invested capital. Again, this is for mining and forestry. So where does some of this data come from? Revenues and total output come from government data sets that track this fairly regularly. The government has an interest in tracking economic output. Like some of those charts we looked at with the forestry GDP, the government cares about the output of private business. So specifically for this matter, there was some data produced by Ontario that looked at mining output specific to RST from the late 40s to the mid 2000s. So that was helpful for answering that first question. What was the output of mining in RST? On the forestry side, there's a lot of Statistics Canada surveys, sort of like the value of log products we looked at back in the early 1900s, but they report fairly regularly on the value. So this isn't direct Crown resource revenues. This is the value of how many cords of wood or how many board feet of lumber times the price. They also have data, because they might have an interest in the labor cost and intermediate input costs by certain industries, including, specifically for my analysis, mining and forestry. So I can use those as fairly reliable estimates. And again, you want on average estimates. Depreciation, there's another data set that looks at a different set of industry categorizations, also available from the government, that gives depreciation, depletion, amortization results, and we can calculate that as a percent of revenues. Again, some of this is done in percentage terms, just because, within the basket of apples, you can measure things the same way. But then if we get a basket of oranges, I can measure them relative to other oranges, but I shouldn't measure them relative to the apples, because that might lead to weird percentages. So in this analogy, if the depreciation data is all based on output and profit and depreciation of oranges, I can express that depreciation as a percent of the number of oranges. That percentage I can then apply to other data.
Let me ask this question. There's 3 bold black lines from Stats Canada data: depreciation calculated as a percentage of gross profits, and return on invested capital calculated as a percentage of profits. Those 3 elements that I just mentioned, are you aware whether any of the other experts say that it was wrong to use that or right? From reading their reports, do you recall if they complain that you shouldn't be using those? Or should?
I don't recall specific criticisms of like the data that, I use data set A and I should have used data set B. Professor Mintz and Mr. O'Riordan raise a question about whether the values I calculate for return on invested capital are appropriate. As I recall their report, I think it's framed as it may or may not compensate for risk, rather than, I used 9.5 and I should have used 12, or I should have used 7. Does that make sense?
Well, I'm just wondering, are we going to get to an explanation of the differences, or like I'm just trying to trying to understand if your approach is disputed by other experts.
Right. I don't have a disagreement slide here because no one else has done a calculation of rents. So I can't say, as I did for net Crown resource revenues, we agree on A, B, C, we kind of agree on D, and we disagree on E and F. There's not a specific alternative calculation of rents. The disagreement, I think, is more whether the rents calculation should have been done.
But in terms of your methodology, you've sort of identified someone saying that you didn't use the right percentage for calculating profits on return on invested capital. I think you mentioned that moments ago.
Well, I think it was framed as I may or may not have used the right.
Oh,
rate.
I'm sorry. Okay.
Again, there wasn't an alternative provided, but I'll talk about that specific calculation on return on invested capital. But as for the other calculations, so Professor Mintz and Mr. O'Riordan also talk about whether depreciation should have been a measure of capital expenditure. I'll talk about that when I get to the depreciation slide as well, because that's addressed in the report. But no, in terms of I can't do a nice grid like we did for net Crown resource revenues of, where we agree and where we disagree on the numbers.
Okay.
Is that helpful?
Yes, thank you.
Okay. So, yeah, this is just the specific line items that are included from the Statistics Canada data of wages, salaries, and employee benefits. That's the proxy for labor. I don't think there's any great question that those are all labor costs and would all be deducted. Again, I don't go in and try to disentangle what portion of those wages or salaries are a function of resource rents. In theory, and some portion of those wages would reflect a sharing of resource rents, but I assume they don't. So that will lead me to underestimate resource rents. Same on the supplier side, the purchased goods, materials, and services. So again, this is your, as suggested, you need a service, you need some material to build something, you need a truck. You're paying a third party to get it. It's possible, I think economics would say probably likely, that that supplier knows they're selling to someone with a rent, you may be able to get a little bit extra. So you may pay $105 for a truck instead of $100. I don't try to disentangle that extra little bit. Though, I suppose if I knew of anybody selling a truck for $100, I should go get that truck. Then I look at the capital costs and I say, again, there's depreciation, which I'll talk about on, I think on the next slide, and then the competitive return to capital. And that's where I'll talk about that's based on a standard financial data set. And then it's just simple arithmetic of total minus each of those colored entries there gets you the rent. So maybe 268. Talk about. So
Yeah. Now we're focusing in on depreciation at slide
Yeah.
268.
you know, why depreciation? If I buy a truck, or yeah, we'll say a truck. If I secure an investor to help me buy a truck, okay, that's going to show up as a capital asset. For purposes of this calculation, I'm trying to avoid getting into the accounting particulars, but if we think about an economic balance sheet, that will be capital, right? I took, maybe I'll say $20,000, so it's more realistic, from an investor. I use that to buy a truck. That investor will expect a return on their investment every year that they've left the $20,000 with me. And I can use it to buy that truck. That truck will then help me generate revenue. But the truck will wear out, maybe say over 10 years, in which case it's appropriate to take a charge, we call it depreciation, that'll be reflected in the books. And so there'll be this $2,000 in that example, subtracted off each year. And that will manifest itself on the invested capital side, that there might be a reduction in the capital assets. And so each year, rather than take a full reduction in $20,000 in that first year. So rather than reduce your first year profits by $20,000 as an expense, it's spread out $2,000 a year for 10 years. And over that period, you pay a return to the investor, because otherwise, if you just paid back $2,000 a year for 10 years, that investor is saying, oh, I didn't get anything for you just gave me back the same $20,000 I gave you. So instead, you have to both take the hit on depreciation each year and pay a return on the total amount of capital invested in the business. That's the invested capital. So it's important to calculate both.
And to calculate them separately.
Yes. And so again, reported, comes from a different Statistics Canada database, depletion, and amortization by industry. I calculate that as a percent of gross profit, so I can apply it to the other database I used. I don't have all the names here, but they tend to have very long strings of numbers followed by a label. It's in my work papers and in the appendix to the report. So I calculate depreciation as a percent of gross profit within that database that gives me depreciation information, and then multiply it by the gross profit from the other database. Perhaps that's a little too mathematical, but the whole point of the percentage is just to, again, make sure I can make the comparisons between the two databases. Now, 269, I talk about the last kind of important calculation of the return on invested capital. So what is this? This is what is the competitive rate to pay to investors to get them to invest in a resource operation? again, if you're putting up the $20,000 or maybe $20 million to fund a mine or forestry operation, you want a return on that compensates you for risk. Not only do you want a return, but as the operator, I would need to provide a certain level of return or no one would invest with me. So there are standard ways to estimate this. Usually, some measure of, I think Professor Stiglitz talked about, return on equity, return on debt. There might be a difference. Here I've used a metric, return on invested capital.
It says I use S&P Capital IQ.
Oh, sorry. Yeah.
What's S&P?
So S&P, Standard and Poor's, is a financial services information company. They might be perhaps best known for their credit ratings, but they also provide a lot of financial data. In this, they compete with Bloomberg and some of these other companies that provide financial data. Capital IQ is their product. I'm putting Cap IQ in quotes. That's often how they brand it. That provides us information. Why is it important? Well, they've collected it from different jurisdictions, different companies. They ensure it's reported on a consistent basis. They include the relevant industry classification from the company. It's really just an amalgam of financial data about companies or deals, depending on what you want to use it for. I use it, it's the tool I use to get data on returns from companies in the mining and forestry industry in either Ontario or Canada. So I can use this tool to be specific. Look at public companies to make sure there's probably consistent reporting of their financials. And I look at metal and mining for mining or forest products for forestry.
Have you used this product before?
Yes. Frequently in my work.
Is it can you provide the court some guidance on its usefulness or reliability in work you've done in the past?
Sure, I've used it in a number of engagements. I know some universities use it. Like if you're a student in the economics or finance department, you might have a license to use it. I think it's generally reliable. I think other tools like Bloomberg, or there's one based in Chicago, there's an acronym, I think it's CRSP, equally reliable tools. I used Cap IQ because we have a license and I've used it before.
Can I just ask?
Yeah.
So when you say it's a tool or a metric to measure or to estimate a competitive rate of return on capital, that is, so you look at the world, or these Standard & Poor, Bloomberg, or somebody looks at the world and says, this is generally what one should expect if one invests in a mine,
Oh,
a rate of return.
actually, the tool just gives me what are all these different financial metrics for all these companies that meet my criteria.
Okay.
I then have to do a calculation of the return on invested capital. And that's, in my opinion, a measure of the competitive return on capital. So it's not quite as black box as that. They give me the data. I then need to calculate two quantities here. The first is net operating profit after tax. The formulas for that are in my appendix, fairly straightforward, but you can think of how much money is left over for a given company. So I do this by company, by year in this industry. And then the net assets, again, they would give you some information from the balance sheet for each of a number of companies that meet these criteria.
And how granular is it in terms of geographic area that you
Well,
looked
you can
at?
restrict as tight as you want. Here I've done Ontario or Canada. You could look though in the United States, you could look in Europe, you could look, where you wanted to look.
But in doing your work, we're in RST. What did you use?
Canada.
Okay. Did you use Canada-wide or Ontario specific, or what? Can you?
Canada-wide. I looked at the Ontario data, but sometimes companies may be listed in other jurisdictions. So I wanted to have more observations. So that's how you calculate this return on invested capital, which is basically trying to answer the question, no matter how a company got its investors, because you can have a mix of investors, right? There can be equity investors and debt investors. We might think of those as lenders. but that's all different sources of capital. And you pay out to them one way or the other, your net operating profits. Those providers of capital have provided you your net assets. And so this metric is saying, you know, if I were this company or a company like this collection of companies, and I needed X dollars in assets to run my business, I would expect to pay so much % per asset. And so if I wanted, you know, I was thinking I need $10 million. What am I going to have to pay my investors every year? The number comes out to be 9.5%. I would say, oh, I should expect to pay them $950,000.
That was just the
That's a
hypothetical.
hypothetical. And, you know, that 950 could come in a mix of, you might pay some lenders a little less and some equity investors a little more. And that's why there's, you know, some wrinkles in the calculation here about estimating, you know, what is debt and what is equity. But this point is really just to get at, no matter how you finance, what is the return?
Now, I understand that the other experts that are going to be testifying have critiqued how you calculate your return on invested capital.
Yes.
Can you provide the court with an explanation of how they differ from you, or what they say about your approach?
Sure. So in terms of, well, actually, in terms of how they differ, as I say, no one's done a return on invested capital calculation for purposes of calculating rents. However, Professors Beaudoin and Smart do have a discussion of risk adjustment that Professor Stiglitz spoke about a couple of weeks ago. Now, I think the purposes for which they did the risk adjustment, we have a disagreement on. But the way they calculated the risk adjustment was, as I read their report, by estimating the differential returns of Canadian mining companies and the Canadian economy as a whole, or Canadian stocks as a whole. And they find that the return to Canadian mining companies is less than the return to Canadian stocks as a whole. I believe 1.7% less. It's in their present value report. And as they say, I think in their words, it reflects the view that Canadian mining companies are less risky than other stocks. Now, again, that's a number calculated for a different purpose, but taking that result, that you'd get 1.7% less than the equity returns to Canadian companies as a whole, that would give a return of about 9.2%, which is less than the return on invested capital that I use here. Not by very much, but a
Which
little
is
lower.
10 something.
So for mining companies, I think it's 9.8. It's in one of my reports. This is a little bit the problem.
No, sorry. The question, it said it would give a return of 9.2%, which is less than the return on invested capital
Yes,
that you use.
yes.
But is it all, but earlier you said it was less than the return on investment in Canadian economy as a whole,
Yes.
which was
Oh, at 10.9.
10.9.
Sorry.
Got it.
Right. So that 10, I'm mixing a bunch of sources. I should have, I guess, had a slide on this, but that 10.9% is coming from the paper of Professor Booth that I think I spoke about last week.
Okay.
So I'm subtracting that. So
Beaudoin and Smart say, well, they don't say, but if your interpretation of their analysis would suggest that they think you used too high a rate or too low a rate for return on invested capital.
Well, again, they don't, I think, address the specific calculation of return on invested capital. Comparing their analysis of the returns to mining companies with my analysis on the return on invested capital for mining companies,
Yes.
their rate is lower than the one I use. So that would mean I would, if I were to instead use a rate derived from the method they applied, I would estimate a lower compensation to capital and therefore a higher estimate of rents.
Mhm.
So the lower, higher, higher, lower is a little confusing.
It's got an inverse
Yes.
relationship. Okay, and so how about other experts?
Again, Professor Mintz and Mr. O'Riordan say I may or may not have calculated the correct rate. I don't recall them offering a specific number, I should have used 12 or I should have used 7, something like that. I will say, when I calculated this return, and maybe slide 270, you can, has it in words. I look at the 70, so you do that calculation on the prior slide for all those years, for all those companies that are publicly traded. You get a distribution of returns effectively. Not every company turns in 9.8% year after year after year consistently, as we all know. Those are averages, so there's a distribution. And I look at the 75th percentile of that distribution. What does that mean? It means the number that's 3/4 of the way up. So rather than the number in the middle, the number that's higher than the number in the middle. And
What effect does that have on your, the outcome of your analysis?
if I were to instead use the median result, the number in the middle, if I can be casual, I would estimate a lower return on invested capital, which is a lower compensation to capital holders, which is a higher rent. Does that make sense?
So, yes, that I understand that. Can we go back to slide 269 though?
Sure.
You've told us about a 9.2 versus a 9.8% amount. The rates of return on invested capital that you work, that you determined were appropriate, how does that square with the academic literature, if at all? Did you look at that?
Oh, yeah, sure. I did look at, there's a database maintained by a professor at the Stern Business School, New York University, Aswath Damodoran. The spelling is in my report, sorry, as a preemptive apology for the court reporter, who maintains databases of a number of rates of return by industry, by time period. And he has estimates of the return to mining companies, and my figures are consistent with those, even though he uses a different approach, kind of a capital asset pricing model approach, an alternative to return on invested capital, very similar in principle, and we get similar results. So I take some reliability from that. That's why I checked those results.
Okay. So did you want to proceed on?
And sorry, that brought you to 9.8.
Yeah, on average,
Okay.
9.8.
Okay,
Which produces a lower rent calculation than 9.2 would.
That's correct. I'll find the specific. I know there's a footnote here, but I'll find it and maybe refer you at the break if you want to read more about these differences. Though I do want to say, all of these differences are not huge. Right? They're not large. Sorry. Okay, so this is just kind of summing up again. If you want to think about the figure Professor Stiglitz showed 2 weeks ago, I've estimated the economic rent by subtracting the different items that appear in green, teal, and blue on this slide: depreciation, return on invested capital, purchased goods, materials, and services, and wages, salaries, and employee benefits. These are, if you will, how I took the general theory, labor, capital, suppliers, and turned them into specific line items. Which specific items did I subtract out?
Okay. So is there anything else you need to tell us on forestry and mining, or should we be going to hydroelectricity?
I don't think there's anything else I need to say. There's lots more detail in the appendix. I could go on with some more numbers, but it might be easier to move
No,
on.
I think we get the picture, and this is all in your report in any event.
Yeah. Okay, so hydroelectricity. The principle of calculating rents is the same. you want to think about total gross output less the costs. Okay. But if you're in a setting where that total gross output is not set in a normal, well-functioning competitive market, you can't use that as your starting point. For mining and forestry, gross output is set in a normal, well-functioning competitive market. The price of gold, the price of wood, they're subject to market forces, not just throughout Ontario and Canada, United States. Those are arm's length prices, if you will. You can't, if you're a mine owner, you're kind of a price taker when it comes to the prices. Whereas for hydroelectricity, particularly when we think about the water rental fees, we have a situation where we've had what Professor Stiglitz talked about, tax expenditure, right? The operators of, or the Crown in its role setting water rental fees has not been thinking about how much it could charge for that cup of coffee. It's been setting prices based on policy, not related to how much people are prepared to pay or what the alternative cost of supply might be. So if we were to just start with the number of megawatt hours times the price paid, we would just get back the same answer as direct Crown resource revenues, because those haven't been set in a competitive market. Right? The Crown has set the prices. So what do? We instead say, well, what's the price of the next best alternative? So if you were considering getting power from somewhere other than Ontario Hydro, what would you pay? And as such, what would you expect Ontario Hydro? And over this period, it's not always been Ontario Hydro, technically, I'm simplifying. What price would they charge?
You just said the next best alternative, but you left out the word, which is in the slide, next best competitive alternative. Is there a difference?
Oh, yes. The purpose of looking at the next best alternative is to estimate what a competitive price might be. So you have to look at the next best competitive alternative. If I wanted to go back to a competition analogy, if I wanted to say, what would a price be if there was competition? I should look at a market that has competition. I shouldn't look at another market with another monopolist, because that's not going to be informative. Sorry.
Okay.
Right. So we have at the bottom, it's kind of a three-step or really two-step approach. The first is to allocate the water rental fees. I spoke about that last week. There's a lot of government data, including some produced specific for this litigation. And then the second part is to estimate the cost advantage. So how much better is hydro than alternatives? So if we go back to our coffee shop example, if I saw you selling coffee for $2.50, even if I could produce at $1, I wouldn't necessarily start offering coffee at $1. I would probably start at $2.45, and we'd see how much we came down. And if I was more efficient than you, if I could make coffee at $1, you could make coffee at $1.50. I would probably price it at $1.49, because I should get the benefit of that, of me being able to make coffee more efficiently. Here, to the extent hydro is a cost advantage over other forms, that should be captured by the water rental fee. That value doesn't come from a specific turbine. It comes from being able to use the water in an effective way. So there's 3 periods of analysis I talk about on the next page, 274, just based on data. And I'm going to start with the middle period, actually, 1977 to 1998,
So
because
you're over on the next slide then?
yes, just because this is a period where there are other academics, other studies that have looked at how to estimate hydro rents. And so I can see the approach others have taken to make sure that the approach I'm taking is consistent with, academic literature, not done for purposes of this case, which is always a good starting point about you think about it the right way. I said on the previous slide, the general way of thinking about rents, but when it comes to practice, I want to make sure that I'm thinking about it in a way that others have thought about it. So basically, you need to think of a reference price. So, we observed what they charged for water rental fees, and you kind of could have charged up to, in theory, 1 penny less than the next best competitive alternative. And so what are some of those other alternatives? Well, there's purchases of power Ontario makes. There's sales where Ontario might purchase power from Manitoba or Quebec. There might be other, in addition to hydro, you could instead run a fossil fuel burning plant, could instead run a nuclear plant. All of these are alternatives. What are their prices? And this chart shows for each of these years, 3 years apart, a comparison of those prices with what was charged for hydro. It's expressed in dollars per megawatt hour. And as you can see, so the different shades of blue and green are the alternatives, and the orange is the hydro. And you can see the costs of either generating an alternative megawatt hour or purchasing it from a neighboring province are uniformly higher than the prices than the cost of generating at a hydro station. Given that, we'd expect the water rental fee to be capturing some of that difference. So I look at the median result of all those other bars and then take 90%. Why 90%? Well, it should be 1 penny less, but I'll say 10% less just to be safe in terms of how high you could set the price. In my example, maybe I wouldn't charge $1.49 for the coffee. I'd charge $1.45 just so people thought they were getting a good deal relative to your $1.50. And a couple of things to note here. That assumes there's sufficient capacity in Manitoba, Quebec, outside providers to provide this amount of electricity. I think that's generally recognized as not true. So probably the real prices would be even higher, but I don't attempt to disentangle that here. And this is consistent with a particular paper written in the mid-90s by Gillen and Wen, we'll talk about in a couple of slides, where they suggested that hydro fees should probably be 5 to 10 times higher than they are if Ontario really wanted to make an attempt at capturing rent value. Okay. So the next slide, I think 276, talks about this competitive benchmark idea. You rightly pointed me to, Mr. Schachter, it's not the next best alternative, but the next best competitive alternative. So the alternative isn't, well, instead of power and RST, you could go to the nearest hydroelectricity facility a couple kilometers over and say, well, that's the price, because that price has also is not a competitive price. It's also a function of tax expenditure distortion. And so you want to look at, I'll say, a clean comparator, something that hasn't been infected by non-market forces. So I bring this up because I think some of the Crown's experts have suggested that you should instead look at somewhere else in Ontario, but it's not avoiding the problem we're trying to solve for, which is, had Ontario not done these tax expenditures, or had they recorded them separately, as Professor Stiglitz talked about, you can either say, I'm charging you $10 and giving you a $9 subsidy, or I'm charging you $1. In the former, you get a full accounting of the value, and in the latter, you don't. You remember? Okay. So the 277, so this is this paper I mentioned, based on this study of the mid-90s. I just provide, rather than go through the details of that calculation with the chart year after year, I estimate a series throughout this period. There's at least 2 other academic studies that have looked at Ontario-wide, what are the rents from hydro? And so
These are studies unrelated to this court case.
that's correct. So I'm just comparing here my estimates to their estimates. So in this first paper, for 1 year, they estimated 1.3 billion. This is in 1995 on slide 277. I estimate 690 million or 0.69 billion. So a fair bit less. And perhaps not surprising because we're taking 90% of a median price. Again, conservatism is built in there because I want to be sure the method will work. And there's this other paper by Zucker and Jenkins called Blue Gold. In 1979, they estimated rents of 750 million, but our method produces an estimate of 191 million, or about a quarter.
Okay, I just want to make sure that we're talking apples and apples and oranges here for a second.
Sure.
The 1.3 billion that Gillian and Wen identify, is that Ontario-wide?
Yes, all 4 of these numbers are Ontario-wide.
Okay. And so you did your analysis Ontario-wide and then attributed a portion to RST.
That's correct. So that's that period in the 70s, 80s, 90s. Now going back in time, there's less data available, there's less interprovincial sales. So instead I look at the cost of generating alternative means of generating electricity. Here particularly fuel. So these are prices from Statistics Canada, from different censuses collected over time. These are representative years. And what I do is try to find the cheapest alternative way, take 90% of that number and apply it in all years. And as it turns out, the cheapest alternative way, Ontario Hydro is on the far left there, is fossil fuel generation in Alberta. Now, I've not adjusted this for the costs of transmitting that power from Alberta or anything else, but I've just taken this as a benchmark, similar to what we looked at before.
Just for the record, we're on 278.
Yes.
Thank you.
278. So take that number and I use it in all prior years. I think that's generally a conservative way of approaching the calculation.
You've got a line here that says using most efficient contemporaneous reference cost would yield estimate several times higher. Can you explain that? Why that's necessarily the case?
Oh, sure. That's just because the cheapest we observe happens to be in 1970. So what does that mean? The prices in 1960, 50, 1940 were actually higher. So if I had used the cheapest in each year to calculate the rents in each year, arguably more appropriate, I would have ended up with higher numbers. I just took the cheapest.
Higher numbers for what?
Higher numbers for rent.
Okay.
A greater cost advantage for Ontario Hydro. And I should say, we take that number, take 90% of it, do the calculations in the same way. I just wanted to illustrate the different data available for that time period. For 1999 to 2019, I'm on slide 279 now. Again, the data are available, aren't reliable, are available in a different format, I should say, for interprovincial sales and so on. And so the easiest way, well, not the easiest way, rather than try to adapt the method that was based on the peer-reviewed papers for that period, 1970 to 1990, rather than come up with my own method for the last 20 years, this is one of the 40% examples where I just say, I'm going to say it's the same as direct grant resource revenues. This
Is
chart
that-
here.
Is that the blue line at the
Yeah, the
bottom?
blue line here. So this chart on 279 plots the unit cost of generation in Ontario for alternative means of production, wood, coal, gas, just to show they still are generally higher than water. But they're not the most efficient alternative means. It might be some interprovincial sales. So the conservative approach is just to take the light blue line where it was. And so that's what I do for the last 20 years. So for hydro, do 100 years from 1919 to 2019. 80% of the time, 1919 to 1998, I estimate the rents directly. And then for the last 20 years, 20% of the time, I take the direct crown resource revenues. So for those 20 years, I've necessarily underestimated rents. But this is just a helpful 3-time period thing to make the point about how the 40% works, if that makes sense. Okay.
And for those people that might be having a non-color copy of slide 279, the blue line is between the $0 and the $10.
Yes, that's right. The one at the bottom is the light blue. Okay. I want to talk about land sales and giveaways. This is slide 280. This is the 4th bucket of potential rents. And just before we get started, you might recall from last week, the Crown sold land and leased it throughout this period, but they also gave away a number of acres of land to encourage settlement under the different free grant programs.
I wonder if we could just wait for a moment. Would the reporter like a break now? I know we've been going for about an hour and a bit.
An hour and 10 minutes, whatever you prefer, whatever's most convenient.
Well, we were just sort of starting a new area now.
Let's do
Now
it
it
now.
might be a good time.
Thank you. All right, 15.
This court will recess for 15 minutes. Thank you. This court is now resumed. You may be seated.
I believe before the break, there was a question about a footnote that Mr. Hutchings was going to look for over the break.
Yes, there was a footnote about the different rates of return we talked about.
Yes,
If you look at the joint reply report, which I think is Exhibit 5, it's footnote 94, talks about the comparisons between my estimates and the estimates from Professor Damadorn.
can you give me that again, please?
Sure.
Page 95
Footnote 94 on page 39
of your report.
of my joint reply with Professor Stiglitz,
Thank you.
which is Exhibit 5, I'm pretty sure.
Yeah.
Okay. The exhibit number was the thing I was less certain about.
Yes. So now you're going to explain to the court how you valued economic, when within the economic rents valuation, how you dealt with land.
That's correct.
All right, so we're at slide 281.
Yes. So let me say there are 2 things. There was,
Can I take a moment?
Yes,
This camera's turned around.
succeeded in breaking the camera. Is that okay?
GoPro.
Oh. Okay.
Okay,
I'm satisfied. Thank you.
It's alive.
Yeah, it's moving.
All right, so you're going to deal with, are we back on the record now?
We are.
All right, so we're going to deal with land. So I'll let
Sure.
you get on with slide 281.
Okay, so as we spoke about last week, there is land the Crown sold and there is land the Crown gave away. For the land that the Crown actually sold, I just take that revenue as is. I don't try to re-estimate it, even though the Crown may have sold it at a rate below the market rate. My focus here in the rents estimate is on the value of the lands that were given away for free through the free grant acts, the different homestead acts, etc., in the late 19th, early 20th century. And I call it rents, but it's really more the direct value of the land. And why focus there? Well, the answer cannot be it is worth nothing.
Why can't it be that it's worth nothing?
Land is the ultimate scarce resource. There is some, it might be a very small price, but there's always a positive price on land, except maybe if you're buying used land and you might inherit an environmental liability or something, but you know, buy an abandoned oil field and suddenly you're on the hook to clean it up, but that's not relevant in the 1870s.
Was it relevant at any time during your analysis?
No.
Okay.
So that's what I start with. And so two general things to be aware of. We talked about last week, not all lands given away for free were ultimately patented. So people didn't always take the effort to go out and crystallize their claim. About 45% of the time they did. So of the lands granted free, I assume only those that were patented had value. The other 55% I assign no value to.
Well, how would you characterize dealing with it that way?
Well, I think that's a conservative approach. As I said, there must be some value, even if it's a kind of option value type thing that in the future it might pay off. Land has something, but those lands that weren't patented, maybe were worth relatively less than the other lands, and it would be more difficult to reliably estimate their price. So I exclude the lands that were not patented.
So when you say you exclude them, you assign them a zero value?
That's correct.
So that land is now, it either remained Crown land or the Crown did something else with the land at another time.
That's correct. Okay. So those are just a couple of things off the bat. There are then two approaches, if you will, to how I calculate the value of those lands given away. The first is that they were sold in the year in which they were given away at a price based on the price in the treaty territory. Okay. The second is that they were rented, if you will, perpetually at some percentage of the value of the land as the land evolved over time. So what does that mean? It means instead of paying upfront X dollars for the land, the person who gets the land instead pays 10% of the value as rental over time. Now, when it comes to the ultimate adding up at the end,
Could it be something other than 10%? Was 10% just an example?
10% was the number I used based on some literature that is in my report.
Okay.
So, sorry. That was both an example and the specific number. In the ultimate adding up, I take the results from the sales approach because they give lower numbers. Though I think the way you would typically think about land value is they will increase over time and the landowner should capture a portion of the unimproved value of the land.
So you pay 10% every year, even though if you had it for 20 years, by now you'd have paid 200% of the
Yes.
value.
Yes.
Okay.
Because the ultimate landowner would say, I'm not sure what the value is today. Instead, I should get a piece going on, particularly in case land prices go up faster than other things in the economy. But as I say, in the ultimate adding up, I use the sales approach. So I'll talk mainly about that.
Yes.
And it does produce a lower estimate. So
A lower estimate of what?
a lower estimate of the value of the land.
Okay.
Right. So again, the analysis is somewhat straightforward. I need in each year the quantity of the land given away and a price for that land. Multiply them, add them up, and we're done. It's made more complicated by the data over the last 170 years. So 282, just a visual representation, I think, of what I described. We have different studies from the Bureau of Industry, Census Canada, Statistics Canada, etc., that give me data for the small geographic parts of RST. I then have to adjust for unimproved land, as we talked about last week. You know, is the land cleared or not? Land that's improved has more value. Adjust for the treaty territory. This is I think I called it the treaty territory deflator last week, but basically the price of land in RST is relatively cheaper than land elsewhere in Ontario, and I want to adjust for that.
When you're adjusting, which way are you adjusting?
All of these have the effect of lowering the price,
Thank you.
and then adjust for the lands patented, as I talked about, that 45%. All of those together lead me to this RST specific estimate of land value. Okay, so if we look at land prices, I'm on slide 283 now. From 1868 to 1920, I can get district level per acre prices from some of these reports of the Bureau of Industries. The main thing to adjust for, and we had a snapshot of this last week in the Net Crown Resource Revenue section, is for unimproved versus improved land. And we can do that at the district level. This is just reflecting, for farmland in particular, the land is cleared. We've already, cut the trees down. It's worth more. Someone is prepared to pay more than if it's not. And so we want to adjust for that because the extra benefit of clearing the land isn't intrinsic to the land itself. That's a service someone else has provided. So if I'm selling an unimproved lot, I'm going to get a lower price than if the court is selling an improved lot. The difference in that is because the court has cleared the land. But to estimate the land price, the land value that's relevant for this exercise, I want the unimproved.
So just before we go on,
Uh-huh.
I note that slide 283 is for a period 1868 to 1920. What about the period 1850 to 1868?
Yeah, free grant lands, we start getting data on, I believe, in 1866, and I think in the treaty territory in 1868. So before 1868, it's not clear that there were any lands granted free in RST. To the extent there were, I assign them zero value.
Thank you.
284. Then for the next 100 years, or from 1921 to 2019, there's a generally consistent time series data from Statistics Canada on Ontario-wide per acre prices of like agricultural land. And there are 3 adjustments to make, as I summarized on the other slide. For the periods where we observe prices of land with and without buildings, we want to remove the price of the building because that's separate from what, as a landowner, you'd expect to capture from selling the land. There's then again, the treaty territory piece that I want something specific to RST. I think I had a table last week that showed on average prices were maybe 20 to 40% in RST relative to Ontario as a whole. So that's another reduction. And then finally is an adjustment again for the improved versus unimproved land, that some amount of that land is still improved and some is unimproved. And there's an adjustment to be made for that. The algebra is on the slide, but yeah.
So
end-
the word cleared is used for unimproved, and cleared does not necessarily mean all the trees have been removed.
Oh, is this
That's
283?
283.
I'm sorry. So the unimproved and improved are reversed here. Cleared is improved,
Right.
occupied is unimproved. My mistake. That's on slide 283.
Occupied and is unimproved.
Mhm.
So what's it occupied by?
Oh, someone might have the land, but they haven't yet cleared it. So
They own it.
Yeah.
But it's not cleared.
exactly. So I forget the slide. It was maybe 200 slides ago. There was you could see the prices in each end.
Mhm.
Cleared is always higher than just occupied.
So just for the unimproved deflator, let's just clarify the slide 283, clarify how it's supposed to read then the first bullet under number 1.
Okay, it should read calculated as the district specific ratio of the per acre price of quote cleared, close quote, improved land to the per acre price of quote occupied, close quote, unimproved land. Is that clear?
Yes, thank you.
Yeah, thank you for that.
Thank you for pointing it out. Okay. So 285 summarizes a bit of what I said earlier. The lands that Ontario did sell, I just take the results from the Nat Crown Resource Revenue section. I don't attempt to revalue that land. And then the lands granted free, I multiply the acres times the estimated value from the prior slides. Again, just a note about the adjustment for patenting. Also include parkland as unimproved land because that is land that was alienated, effectively sold
Mhm.
to a park, and you'd normally expect a private party to be compensated for that land.
Now, do you recall from reviewing any of the other experts' reports, whether there's any complaints about your methodology and how you dealt with land sales?
Yes, I think Professor Mintz and Mr. Reardon in particular disagree that the lands that were given away had value had they not been given away. Put differently, I think what they're suggesting is the price of land is zero.
You don't agree with that, of
Right,
course.
I don't agree with that because, particularly if we adjust for the lands that were patented, there's some cost, time cost, money cost to patenting your claims. You wouldn't undertake that if it was valueless. So there has to be some value. More generally, as I said earlier, land is the ultimate scarce resource, as economists would say, and there's value in having that land. And to the extent the Crown was either giving away land for free or selling land to those who received it for free at a reduced price of 50 cents an acre, that has maybe suppressed the otherwise observed prices, because if you're a private person trying to sell your land, you're then competing with the Crown who's giving it away for free, which will have the effect of generally depressing prices. So there's kind of two, I think, potentially offsetting effects here. One, the kind of observed prices are almost surely too low that I use to estimate value because the Crown has been in there giving away land for free. So back to our coffee example, if I'm giving it away for free, you may have to sell at a loss to try to compete because I can somehow give it away.
Right.
That's going to suppress prices. And then Professor Mintz and Reardon, or Professor Mintz and Mr. Reardon, I think have the concern that there's a selection bias problem, that the lands given away were maybe the less desirable lands.
How did you correct for that, if at all?
Well, part of this is removing the lands that weren't patented. So at least of that population, the 55% that weren't patented, I'm taking that as a signal that those were at least worth relatively less than the others, to try to account for any potential bias there. So these are lands that have some value. And
Sorry, you said they're relatively less, but you told us earlier you gave it a zero value.
Exactly. So they are relatively less. I've assigned them zero. Again, I believe zero is wrong, but to then use observed transaction prices to price those, I wouldn't have the same level of reliability. So on that 55%, I've necessarily understated the value because I've said it's worth nothing.
Yes.
And I started with it has to be worth something. So I think both of those adjustments would offset for any selection bias, is the technical word that I think Professor Mintz and Mr. Reardon are talking about. And I don't think they offer an alternative calculation as to what would be a more appropriate way of adjusting. But I've certainly taken steps to try to account for that fact that some of these lands may be relatively less valuable. And I've taken a rather extreme approach of giving zero value to a large chunk of them.
Okay, thank you.
Could I just see if I've got this right? If the 55% not patented. So it might have been given away, but it reverts back to the crown.
Yes.
Ownership reverted back to the crown. Okay.
Yes.
So it's like selling it twice. Like the first time they sold it for 0, or they gave it away.
Yeah.
And the
it
next
could
time
be
they could've
twice.
sold
It
it
could
for-
have been a Crown Corporation is there. And
Right.
I haven't gone through a tracking of every block, but
Okay.
I would expect it just goes back into the pot, if you will, of land. Is that helpful?
I think we're gonna move on to slide 286.
Yeah. Okay, 286 is just discussing the mechanics of the rental approach. As I say, I think economists prefer this sort of approach because it's a way for a landowner to continue to get the benefit of their land, it being the ultimate scarce resource, by not selling it, but instead sharing in the growth of the land value over time. It produces a higher value. And so I use the sales approach just to be conservative.
When you, so in your rental approach, you don't, sorry, in your valuation of land, you end up defaulting to the sales approach, not the rental approach.
That's correct.
Okay.
Had I not done that, my values would be higher.
Okay,
Um,
that brings us to valuing spectrum.
Yes, so over on slide 288, this will be brief. Because, and we spent a lot of time last week talking about spectrum. Because there are auctions set up, economists like auctions because they're typically a way to get private companies to compete for natural resources. It probably comes close to capturing the value of the rents. I haven't gone through the details of how all the auctions are done. In other jurisdictions, there have been some concerns that these auctions aren't efficient. But rather than unpack that, I've just accepted the net crown resource revenues as an estimate of rents. It seemed, any alternative method would involve some more assumptions, and I couldn't be confident in the reliability, and these seem like a reasonable estimate. So I've just adopted those.
So I take it 289 is a summary. Can you just explain what this is? At slide 289?
Sure. So slide 289 is the calculation of the 40%, if you will. It highlights in orange the resource years, or the periods of time for each resource, when I default to what I call actual revenue, which is direct crown resource revenue, instead of separately estimating rents. So, and then the blue are those times where I did estimate the rents using the methods we just discussed. So again, for each of those orange or red shaded cells on slide 289, I've underestimated the value of rents.
And now that you've dealt with the rents themselves, you have to deduct off the expenses, I take it. For
Yeah.
crown expenses.
Yes. So as economists would normally think about rents, it's total output less all the costs necessary to generate that output. I've spent a lot of time talking about the kind of private party costs, if you will. You have to pay labor, inputs, suppliers, capital, etc. But in Canada, in Ontario, and in RST specifically, the Crown does some of those things. We talked about it last week. It surveys the land. It builds a mining access road. It manages some of the timber stocks. Those are necessary expenses for getting the full value of the resources. And so we should deduct those as well. I deal with it in a separate section here just because it's a different data source. We're back into the public accounts, even though conceptually, we should try to be allocating Crown expenses to the labor we discussed earlier. But given how the data are reported, it's simpler to take private costs of extraction and then public cost of extraction. And that's what I know here. Private party expenses were already removed above. So I start with all the expenses I identified as relevant for the direct crown resource revenue analysis, those are all still relevant. Okay. So you still need to do all of those activities. Then there are 3 categories where I add additional expenses. Because now that we're measuring a broader, or now that we're using a broader measure of benefits on one hand of the ledger, we need to make sure the expenses match, right? The matching exercise has to remain at the front of our minds.
You just moments ago talked about you still have to do that exercise. I don't have a monitor in front of me, but did you mean you as the economist still has to calculate those NCRR calculations?
Yeah, me as the economist, I still have to calculate.
You know,
The
you said
expenses.
you still have to do those things, or I'm paraphrasing. I don't have the
Okay.
monitor in front of me, but I'm pretty sure I heard you say you still have to do those things. And I thought, I just want to be clear, we're talking about you as the economist doing it, or are we talking about the state has to undertake all of these expenses? What were you talking about?
Oh, I was talking about the economist still has to deduct those expenses. In this world where we have assumed that everything happened exactly as it happened, that would mean the Crown still incurring the expenses that it actually incurred as measured in my direct Crown resource revenue calculation.
So, but the quote was, so I start with all the expenses I identified as relevant for direct Crown resource revenue analysis. Those are still relevant. So you still need to do all those activities. The activities being
sir.
done are by the economist.
No, the Crown still has to do all those or would still be doing those activities. I, as the economist, still need to count the expenses of those activities. Sorry.
Thank you.
Okay.
So you were
Sorry, I
going,
forget where I was.
yeah, you were, that's my fault. I
No worries.
apologize. You were going to explain, I think, how your NCRR calculation is broadened in some way,
Right. So
and why, I would ask.
right. So a couple of things. What are the additional benefits we're counting that I didn't include in my NCRR calculation? And then what are the costs incurred by the Crown that support those benefits, right? If we've broadened the set of benefits we're measuring, we need to see if we need to broaden the expenses. So there are 2 important ones. The first, because I have included a value on the lands granted free, I need to include expenses related to those land giveaways. You may recall last week, I spoke about because the land is given away for free, there's no direct resource revenue. And so it would be inappropriate to include the expenses of those activities. If you're giving it away, by definition, there were no revenues. For purposes of this calculation,
This calculation
this
be
calculation be the
rents.
rents calculation. I'm including a value on those lands, so I need to include those costs.
This is back to your response to criticisms, or your criticisms of other economists who you say used an expanded definition of expenses and a narrow definition of revenues.
That's correct.
This is, and you are demonstrating as in summary how you've done it, and you are demonstrating that if you used a broad definition of revenue, as you did for land given away, you assigned a value to it, then you must use an expanded definition of expenses.
That's
Do I
correct.
have that?
That's correct.
Okay.
Yep. So there were 2 important things, 2 quantitatively important things that are different. So the first is I include more land agent salaries. You might recall last week I spoke about the land that was given away. Some land agents worked on giving that land away. We shouldn't include their salaries. I undo that adjustment. And the second is that I include some colonization road expenses, because these were roads built to facilitate the giving away of free land and colonizing. I now include some of those expenses. Specifically,
Sorry, go
oh,
ahead,
yeah,
specifically.
specifically, I look at the percent of lands granted free in RST versus the percent of lands granted free in Ontario as a whole. That number is a little under 20%, 19 point something. And I allocate that percentage of colonization road expenses, because again, colonization road expenses tend to be booked or recorded at the Ontario-wide level in the Ontario public accounts. I allocate that percentage, the 19 to 20%, to RST. So I include those.
And how about any of the other experts when they deal with colonization roads? How does that, are you able to comment on how they treated what that 20%, if that's consistent with what they did when they looked at rents?
Sure. So professors Bodway and Smart, they don't do a rents calculation. But when they look at expenses from colonization roads,
Well, we've already seen that they dealt with expenses based on expenses related to rents.
right? But they only do one, they don't do a rents calculation, they do a net crown. They represent that they do a net crown resource revenue calculation. And in that, they included transportation expenses, which I disagreed with last
Right.
week on principle because they didn't support the revenues. Now that I'm doing a rents-based revenue analysis, I include some portion.
Some portion versus what Bodway and Smart did, which was 100% of colonization roads
Right. In their NCRR
in their
analysis, yeah.
NCRR
But
analysis.
when it comes to allocating it to the RST, they use the same method I used for rents. So they use, I think, the similar 19 or 20%.
Right.
They have a discussion in their appendix that they thought allocating based on free grant lands granted in RST versus those granted in Ontario as a whole was reasonable, and they used my allocation methodology. So, you know, they do that, I guess, for both NCRRs and rents, even though they only do one calculation. I say for NCRRs, because there's no revenues, you shouldn't include any. When you include a measure of the benefits of free grants, then you should include 20%. So when I take a broader approach that kind of matches their broader approach, we allocate it geographically the same way.
Mhm.
Is that?
Yeah, I think that's what I was trying to understand.
The last thing is because forestry rents are broader than just forestry net crown resource revenues, I include a portion of fire expenses after 1917, 30%. This is based on, we spent a lot of time talking about this last week, but it's based on that ratio of the first like 15 years they had mechanisms to recover the cost of firefighting. That was about 30% of expenses. So I now include those as relevant expenses because I'm asking the question effectively of, you know, should the stumpage maybe be a little higher? So I include those because, again, I've broadened. I think forestry spent a lot of time talking about the balancing of benefits and expenses. I'm now broadening the benefits.
Okay.
Those are the big changes. So what does all this lead us to? Well, it leads us to,
Just before you go on, you said those were the bigger changes. The other changes are reported in your work papers
Yes.
and in your report.
that's correct. Right, so slide 293 is in nominal terms, the takeaway, if you will, from all these estimates. So reading, no, which way we want. Let's go left to right. So this chart reports by decade the estimate of rents in nominal dollars. This is the period 1850 to 2019. And yeah, it's in nominal dollars. So it doesn't do anything with the time value of money. So you can see we have mining, forestry, hydro, land sales, spectrum. We get a total, and then we get a total net of crown expenses. So in the bottom right, that's the 3.58 billion number that Professor Stiglitz spoke to 2 weeks ago. Now, over the page, we have this in present value. This is present value as of March 31st, 2020. Doesn't say it here, but it's consistent with all the other tables we've looked at. Is again expressed in millions of dollars. The setup is the same. And in the bottom right, we get the takeaway of $126.3 billion, which I think is also the number Professor Stiglitz spoke to last week, 2 weeks ago. Before we move on from rents, just make a couple of points about the conservatisms. These are my estimates of rents. Given how I've done the estimation, this is an underestimate of rents. 40% of the time, I use direct Crown resource revenues. That's that, sliver of red, not trying to estimate the whole bar of gold.
Right.
So that necessarily understates. I make what I consider conservative assumptions on selecting the return on invested capital. We talked about, I use the 75th percentile. I don't just take the averages. All of that means higher compensation to input providers, which lowers rents. I don't try to disentangle any rents that may have been captured by suppliers of labor, workers, sorry. It's a very economist way to think about suppliers of labor, but workers, or other suppliers of intermediate goods and services. And, for hydroelectricity, I use, tend to use the kind of lowest observed values in that earlier period, 90% instead of 1 cent less, and in some years use the direct estimates. So these are just some examples of why the numbers I just showed on the previous 2 slides are almost surely lower than the true value.
And so what does slide 296 tell us?
Right, so slide 296, you'd asked earlier about the response from the Crown's experts. And I said, nobody does an alternative rents calculation looking at rents on both the benefit and the cost side.
So apples to apples, oranges to oranges.
Exactly. And we've talked about some of the specific criticisms as we went along. But in general, there haven't been alternatives provided to give a sense of how important, if I did not appropriately account for the value of land, I don't have an alternative number that someone has said, you used $1, you should have used 73 cents, that I could see what's the impact. Professors Bodway and Smart, though, do provide a list of Crown-related expenses that they consider relevant. They discuss this in their rebuttal report to my and Professor Stiglitz's report. And as we discussed last week, in their NCRR report, they set up a narrow measure of revenues, but on expenses, talk about expenses that support rents. Now, there are several allocation problems there. The smell test of forestry, Professor Stiglitz talked about, but that is a specific list of specific criticisms. if you
So,
will.
right, and so you don't agree with their Crown expenses related to rent,
That's correct.
but for the purposes of this slide, you're somehow trying to illustrate something using their expenses.
That's correct. So if I take their Crown expenses from their net Crown resource revenue report, which they describe as expenses that support resource rents by the
Yes.
Crown, and I compare those against my gross estimates of rents, the 3.58 billion mentioned earlier, then I get the bottom line of this table on 296, which is a nominal estimate of 1.074 billion. And in present value terms, that would be 15.3 billion at their preferred rates, or 79.8 billion at my and Professor Stiglitz's preferred rates. So I just wanted to provide that to the extent, kind of as I did in the net Crown resource revenue section. I think it's helpful just to see where are the differences. This is the one specific criticism of rents that came up, so I wanted to provide the impact on this. Now, the difference between those 2 lines, I disagree with a lot of those choices as we talked
Those
about.
2 lines,
Sorry.
which 2 lines?
The 2 lines in the tables. So-
On 296.
The two lines on the table in 296, the Stiglitz and Hutchings rents and the Stiglitz and Hutchings rents using Bodway and Smart expenses. That results from the over-inclusion of expenses we talked about last week. Big one being the forest management that leads to all those losses, but accepting all of that, we get this result. So I just wanted to present
This
that.
result being the result on page 296, slide 296.
That's correct.
1.074 billion.
Yes. Which
So-
is,
So if I could just
yep,
make sure I've got this. So if you take the Stiglitz and Hutchings approach to rents
Mhm.
and the Bodway and Smart approach to expenses,
Uh-huh.
you come up with a nominal value of 1.074 billion.
that's correct.
Okay. And so the difference between 3.5 and 1.07 is, as you say, the over inclusion of expenses primarily in forestry.
That's correct. Forestry and transportation would be the two big
Oh,
ticket items.
both.
And with the bring forward, that leads through to the differences between the 79.8 billion and the 126.28 billion.
That's correct.
Can I just catch up for one brief moment? Okay, thank you.
Now, Mr. Hutchings, I take it you were able to run those numbers because you recently received from Ontario the work papers for Bodway and Smart? The sewer apply and the work papers, or did you need the work papers to do it?
Sure. So I ran a version of this calculation in my reply report from October of last year using the work papers as provided last summer. And that's mentioned there in footnote 213. The numbers will be slightly different, but the message is the same, that the rents are still significant. I then updated the numbers in these presentations using the work papers I received last week or 10 days ago, based on their December 2022 SIR reply.
Right, okay. And for the court's knowledge, I don't believe those work papers are yet in the record, but they will be, I'm certain. That takes us then to the last part of your presentation, or last task you were asked to do, which was to account for the relative wealth and needs of the Anishinaabe and the settlers in estimating the income gap.
That's correct. So on slide 298 here, I have the basic charge, right, of what was the relative wealth and needs of the two communities. Professor Stiglitz spoke about this a fair bit 2 weeks ago, but I'll just summarize. We measure the difference in relative wealth and needs by looking at the gap in average total income per capita. Now, there are two kind of practical reasons for this. First, data on incomes are more readily available, particularly over this length of time, rather than wealth. And as we'll see, we don't even have reliable income data all the way back to 1850, but we get pretty close. And the second is we know the direction of the bias. What does that mean?
So, sorry, you say we know, who's we?
Economists generally, that this is based on statistics, Canada reporting, academic literature. What do I mean by we know the bias? Well, we know whatever gap we observe in income disparities, the gaps are larger when it comes to wealth disparities. We have an example in our opening report, our joint report, where we talk about the amount of income that's earned by the top, like 1%, versus the amount of wealth that they hold. The share of wealth is greater than the share of income. that's generally known. And so as a result, if we were to try to measure disparities using wealth instead of income, we would end up with higher amounts because we know the differences are bigger. Why is that? Well, if you have more income, you can save and invest and grow that. Whereas if you're consuming all of your income, you don't have the same opportunities. And income is well correlated with other measures of well-being, education, health, longevity, quality of life. So the math, as shown in the middle bullet here of slide 298, is relatively straightforward. We need the per capita gap in each year times the people who live there. I get that data from Dr. Bignami, who I understand will be testifying later in this trial. And we add it up. Again, easy to say in words, difficult in practice with 170 years. But let's start by talking about how we get non-Indigenous income. So fairly reliable data from Statistics Canada from 1976 to present. I use the Canadian Income Survey, which is one of those usual, let's say, census type products by Statistics Canada that gives us annual data on total income and the population of Ontario from 1976 onwards. Before 1976, I estimate total income per capita, assuming it tracks with the rate of change of gross national income per capita in Canada, because that data series goes all the way back to 1870. Gross national income is, as it sounds, the income of not just the people, but also corporations, other things in Canada. But what I'm looking at is the rate of change of that series. So I extrapolate going backwards.
What can you tell us as an economist about the reliability of using that measure?
I think it's a generally reliable measure. Because I'm looking at the rate of change. I'm not pretending that individuals earned as much as the country as a whole. I'm just saying the rate of growth in individual incomes is correlated with the rate of growth in national income. That tends to be borne out, as you might imagine, as the country does better, most people do better.
Now, I note that there's nothing here prior to 1870. What did you do for the period 1850 to 1870?
For the period 1850 to 1870, I assumed that there was no gap in incomes. I didn't feel there was reliable data available to extrapolate further back in time. And rather than speculate or provide an estimate, I felt a simpler solution was to say there was no income gap. That does have the effect, of course, of underestimating the total income gap, because presumably it didn't just appear in 1870.
The income gap didn't just appear in 1870.
That's correct.
Okay. Thank you. Slide 300, I think.
Yeah, slide 300 talks about where we get data for the RST Anishinaabe. So for a number of years in this period, late 19th, early 20th century, there are reports from the Department of Indian Affairs, as it was then called, that reports income and population by agency. Again, at this time period, agency is just the administrative subdivision used by this department. We can map the agencies to the area covered by RST. That data begins in 1898 and is available periodically until the 40s. Before 1898, I assume the gap is the smallest gap that I observe in that period, 1898 to 1946. I have a chart that shows that in a little bit. And for the couple of years where there's not agency-specific information, I take Ontario-wide information, though, as it may not surprise, and we'll get into this a little more later, the incomes of Indigenous people in the RST tend to be lower than Indigenous people in Ontario as a whole. So I think that's, again, a conservative assumption, but it only affects a couple of years.
Okay.
So here's an example of the 1917 report, Department of Indian Affairs. So you can see we're looking at Fort William, which eventually gets renamed Port Arthur, but basically is the Thunder Bay area. And so this is a snapshot of what's provided, all kinds of different income data. And on the far right, you have that column, total income of Indians. So this is what the federal government is saying. In 1917, all the Indians in Fort William earned $83,546. $1.28. Now, I can use population data from the same department report. And here's perhaps, before we get to the next slide, I should mention, I understand there's a dispute as to whether or not Canada accurately counted the number of Indigenous peoples in RST. I understand that's what Dr. McNamee is going to speak to. But for purposes of this calculation, to do a per capita estimate, it's important to take the number of people as counted by Canada, because it's those people's incomes that are being reported in this 83,546. So if I were to use a broader measure of population, I would bias my results. So on the next slide, we have Fort William Agency. This is slide 302. That 1,569 is the population as reported by Canada in 1917. So I'll be careful. So we do this exercise for each of the years, for each of the agencies. We get the results in slide 303, which shows income per capita. The bold line is weighting those up for RST as a whole.
So you've got 3 agencies. Why only 3 agencies?
Those are the ones that overlap with RST.
Okay.
Excuse me. There were many more in the report. I think we saw the snapshot a couple slides back. There's a
Right.
lot more.
But those are the 3 that overlap with RST area. Got it.
Okay.
So will you ask, or will anyone advise whether those areas, whether there's any dispute with the fact that those named areas are in the RST? My, general understanding of the province would lead me to worry about Chapleau.
Yeah. How, what made you think that Chapleau was in the RST?
Based on maps at the time, part of it was an RST, part of
Right.
it was an RHT.
Okay.
So
That was your concern, right? It's too far east.
I
I'm
see.
just presuming you went,
Yeah.
you told us earlier of how you put maps on top of things,
Yeah.
and
So how did you account for the fact that, for example, Chapleau, only a portion of Chapleau income, or only a portion of the Chapleau area that overlaps with RST?
Well, I include it together with the other agencies and take kind of weighted average. Like if you take 1911 as an example, the $46 at the bottom is not a straight average, so you can do it by population. But I agree, there's a bit of mixture there, but I'm not sure also within Chapleau, if people have relatively higher incomes in the east or west part, it is an assumption, but I didn't think I could improve on it.
Okay.
I don't think anyone's proposed an alternative. If we were to remove Chapleau, I think if anything, well, it's offsetting. In some years it's higher, some years it's lower. I don't know the impact of removing Chapleau on these data.
You considered it to be sufficiently reliable enough for your estimation?
Yeah, I mean, again, I shouldn't say I knew. Looking at the maps, part of it would be relevant. It's difficult to then figure out exactly which parts, but I thought it's data on an agency, part of which is in RST, so I wanted to include some of that data.
Okay.
Particularly say in 1911, when it looks like they're earning a lot more per person, I wouldn't want to exclude that and then make the gap bigger. Does that make sense?
It does make sense. Do you recall if any of the other experts thought that you weren't using the proper agencies? I don't recall reading that.
No, I don't recall. I think most of the other experts focused instead on measures of wealth or more contemporaneous measures of well-being. I don't recall any mechanical criticisms of this calculation.
and I don't want to assume that I know how that mapping is done in any way.
No,
Is your methodology explained in your report
yes.
in greater detail?
Yeah, and in the work papers, and like those snapshots with some of the pink
Mhm.
coloring, those reflect some of the work papers part of the package. So I'm happy to take a look and explain further if need be.
Okay.
So this slide 304 plots basically the ratio of RST Anishinaabe income as estimated on the prior slide against non-Indigenous income as estimated based on the slides a couple slides ago using the data from Canada. And so what does this say? Well, it says that on average, the income per capita of the RST Anishinaabe it ranged in total from maybe 15% to 48% of non-Indigenous income, and generally was between 20 and 30%. So for every dollar that a non-Indigenous person earned, someone in RST, an Anishinaabe person in RST would have earned 20 or 30 cents. And I've circled, this thing at the beginning to say, that's the smallest gap I observe is at the beginning in 1898. And so that's the gap that I use to extrapolate backwards to 1870.
Back to 1870.
Yes. So all of that generates this chart, which Professor Stiglitz, I think, spoke to a couple of weeks ago.
This chart being the one at 305.
Yeah, slide 305. The orange line is the income per capita of the RST Anishinaabe using that table from a couple of slides ago. And the green line is total income per capita in Ontario. And you can see, well, there's a difference between those two lines. The green line is uniformly higher than the orange line.
And so that's the income gap,
That's correct. And then in the, I say in the background, but
the gray shaded area.
also plotted on this, yeah, is the gray shaded area, which is the net crown resource revenues, as I calculate them, from the RST in each year. And that's also, I should mention, there are two different vertical axes. The per capita incomes for both the green and the orange line are graphed on the left. So total income goes up from a little under $100 to a little under $700 over this period. The RST net crown resource revenues are graphed on the axis on the right. So they go up from, I don't know, maybe $40,000, $50,000 in the 1870s to, close to $1 million at the end. The last several years are above 500,000. And that last gray bar goes all the way up to $1 million.
Sorry, gray bar is
Right.
graphed on line to the right.
Yeah.
Thank you.
So I mean,
And per capita income on the left, the per capita income wasn't $500,000 during this period.
so I appreciate earlier in your testimony, you talked about using different scales, and here we've used different scales. But you're trying to demonstrate something. What does the gray area tell us in its shape? I appreciate if it used the same scale, it would be a lot higher than the green line.
No, I think in its shape, it's when the RST started producing a lot more net crown resource revenues. So say from, 1950, 1920 onward, the gray area is quite high relative to where it was. We don't see much of an increase in the income per capita of the RST Anishinaabe. Whereas we do see in the green line, a fairly substantial increase in per capita incomes in Ontario. So at the time when the Crown is collecting more revenue from RST, we see well-being in the province increase overall, but we don't see well-being for the RST Anishinaabe increasing. Right, the orange line goes up a little bit, but it's maybe doubles from 1915 to the end, whereas the green line more than triples. And the gray area, which is the net crown resource revenues, go up a lot. So this would be consistent with the benefits of those net crown resource revenues not going to the RST Anishinaabe.
Thank you.
Just give me one moment, please. Thank you.
So over to slide 306 then.
Yes, so the next couple of slides talk about the mechanics of calculating the income gap in the most recent period, 1986 to 2019. We start in 1986 because that's when we start getting reliable reporting in the census on Aboriginal identity and Aboriginal origin once those questions start being asked on a regular basis in the census. For the period then between 1946 and 1986, I do an interpolation. That's why we've jumped from 1946 to 1986.
Okay.
Just because the data in the middle period, for whatever reason, the Department of Indian Affairs stopped reporting that detailed agency data. And then Statistics Canada didn't start reliably tracking things about Aboriginal identity and origin until 86. So that's why the gap. And the gap is fairly straightforward. We have to adjust for the geography is the main thing. Because if we have Ontario-wide data on Indigenous incomes and non-Indigenous incomes, that's one measure. That's the first thing there. Ontario gap in percent per census, the slide 306, the first thing in parentheses. Then we multiply that by a geographic adjustment factor, which is to take account of, well, maybe things in the RST are different. And then we multiply by the income per capita in dollars.
Right.
So I'll go quickly here. So just looking at, Ontario as a whole, if we were to look at Indigenous to non-Indigenous income, looking at people who identify as having Aboriginal identity or Aboriginal origins, that's the left two columns, or those who are First Nations members, that's the right two columns. We see that the income gap is smaller for those identifying with Aboriginal identity. And that's the gap, that's the series I use, the thing in orange there. You see it's between 55.6% in 1996 and 66.3% in 2016. That's the data series I use. That's a broader
I'm
measure.
Sorry, but the Anishinaabe are First Nations people,
Yes,
but you've used Aboriginal identity. Why?
it's a broader measure and it tends to show a smaller gap. So I didn't want to overstate the gap as it comes to different measures of identity. I also wasn't sure how Professor Bignami's measure might compare with how Canada tracks First Nations members. I understand there's a dispute there, so I may be calculating a gap based on Canada's data on the right-hand side and then applying it to a measure that includes people with Aboriginal identity as Canada might measure them. Does that make sense?
And is that measure from StatsCan?
Yeah, this is all from Statistics Canada. this slide.
And First Nations only is a measure of band registration or registered with a First Nations
I-
community?
I
or
think
do you
it's
know?
again self-identified on the Statistics Canada form, but it's meant to be those affiliated with the First Nation. They also have a measure of on reserve, which I get to a little later, but all of those are self-identified on the census. I don't.
But using the Aboriginal identity column that you've circled in red.
Yeah.
Lowers or reduces the income gap
That's correct.
calculation. So it's a measure of conservative.
Sure.
I got it.
Yes.
Okay.
Slide 308 this is a snapshot of Ontario-wide data in 1986, just so we can get a sense of what the data might look like. We're now at a geographic level of census subdivisions. So we look at the census subdivisions or metropolitan areas that are relevant for the RST. And so you see here Algoma, Michipicoten, Thunder Bay, etc. And we have two sets of data here. People of Aboriginal origins off reserve. So this eventually evolves into becoming Aboriginal identity when StatsCan updates its census. And I want to focus on column 6 here. This is, in percentage terms, the income per capita of an Aboriginal person in one of these census subdivisions relative to the income per capita of an Aboriginal person in Ontario as a whole. So the average down at the bottom in orange is 73%. What that means is Aboriginal peoples living off reserve in RST earn about 73% as much as Aboriginal peoples living off reserve in Ontario. So they tend to earn less. Indigenous people in RST earn less than Indigenous people in Ontario as a whole. The next set of columns look at the same sort of calculation, but focusing on everybody except those with Aboriginal origins. So this is a kind of proxy for settlers, if you will. And you see that in Ontario as a whole, this is the first entry in column 8. That's $13,670. So that's the whole province. Column 9 looks for each of the divisions and metropolitan areas. What is the ratio of people in that area? So again, Algoma, Michipicoten, Thunder Bay, to Ontario as a whole. And you see at the bottom there, I don't have them circled, but you see a 96 and 98% on the last 2 rows. That means that the average non-Indigenous person in RST earns about the same as the average non-Indigenous person in Ontario. And so
Or
we
within
need-
4%, I guess.
yeah, between 2 and 4%. Whereas, whereas for those with who identify as having Aboriginal origins, it's 73%. So there's a bigger gap. So what does that say? That means we have to adjust for RST further. This is the geographic adjustment factor I spoke about.
And just on those last 2 rows, it says RST CSD.
Uh-huh.
What's a CSD?
Census subdivision.
And below that, the last row, RST CMA/CAs.
Census metropolitan area, and then census agglomeration. Those are just different ways that StatsCan kind of slices and dices the country, if you will.
So can I just check this out? If an Aboriginal off-reserve person in Ontario or in RST earns 73% of an off-reserve Aboriginal person in Ontario as a whole.
That's correct.
Whereas for a non-Indigenous person or non-Aboriginal person as defined here, the difference between the RST territory and Ontario on a whole is 98% or 96%.
That's correct.
Okay,
So the last column, oh, sorry, I guess we can stay.
Thank
there.
you.
The last column, column 10, kind of shows the implication of that. The first row says that in Ontario as a whole, someone identifying with Aboriginal origin earns 63% as much as someone who doesn't, right? So our income gap in Ontario is 63%. Or I guess the gap is 37%. You're earning 63 cents on the dollar. But the bottom 2 rows show in the RST, that gap is larger. It's 47 or 48%, which means you're earning, the gap is over 50%. That's mainly the main takeaway, is we need to take that into account when
So-
doing the calculation.
say what that number represents, that 48%.
The earnings of a person identifying as having Aboriginal origins in the RST is 47% of the earnings of a person not identifying as having Aboriginal origins in the RST.
In the RST.
In the RST. So Ontario as a whole, 63%. RST specifically, 47 to 48%.
So the gap is even greater.
Exactly.
And I notice you've told us you were using people of Aboriginal origin, but now it's off reserve. What about on reserve people? Did you look to see if they earn more or less?
I did. They earn less. I have a slide coming up in a little bit.
Oh. But you didn't factor in that.
That's correct. This is the same sort of table. This is slide
This
30.
being slide 309.
Yes, slide 309. We go through the same exercise. This is using 2016, just kind of bookending the 2 censuses that are relevant for this period. And so we see, now we flip them around just to keep it fresh for everybody. In column 7, we have Aboriginal identity. So it's 87%. So you see that gap that was 73% is now 87%. What is this? This is a person who self-identifies as having Aboriginal identity in RST, earns 87% as much as a person self-identifying as having Aboriginal identity in Ontario as a whole. So RST relative to Ontario has come down a little bit. We see in column 5, looking at non-Aboriginal identity, that number is 98%. So again, your average non-Aboriginal person earns about as much in RST as they earn in Ontario as a whole. And so but there's still a gap, so we still account for it.
The gap is getting better though.
Yeah, the gap relative to RST versus non-RST.
It's
Ontario,
lessening somewhat.
yes. Ontario-wide, the gap has only shrunk from 63 to 66% over this 30-year period. So still a ways to go.
Right.
On slide 310, this is what you just suggested, Mr. Schachter, of there are yet other ways of measuring whether or not someone is an Indigenous person. And here we look at, again, just a snapshot from 2016, when we look at census divisions in RST. And this is because there was a particular study done in this year that we have RST, historic treaty area. But you see, again, the earnings of people with that Aboriginal identity lower than those, the settlers in the first row. First Nations only, we restrict that circle, lower still, limiting to on reserve, lower still. So that gap on the far right-hand side keeps growing. And I use the first row of Aboriginal identity.
Well, it's the second row, but
Sorry,
in your calculations, you use the 58%.
that's correct.
And so that, as you say, it's a conservative measure. I see that. Okay. In the calculations you did concerning the income gap, do you recall, or is whether any of the other experts had concerns about your methodology?
I think the other experts expressed concern about the choice of method, if you will, whether or not calculating historical gaps in income was relevant.
Right.
There were some concerns raised. I think Professors Bodway and Smart, and maybe Professor Mintz and Mr. O'Riordan talked about mean versus median, total income versus after-tax income, some choices about this, but not with the general approach of, if you wanted to calculate an income gap, that you should look at the incomes of the two groups you're trying to compare over time and multiply it by the population.
And after considering their, I'll call it concerns or their opinions, did that cause you to change your opinion on what you would advise the court about the income gap?
No. So let's take mean versus median first. I think Professor Stiglitz spoke about this last week or 2 weeks ago as well. What are mean and median? A refresher. Mean is what most people think of as the average. When you add up all the results, divide by the number of people, that's your average. The median is that number in the middle, if you will. If you ordered all the numbers smallest to lowest, the one that's halfway up would be the median. So the median doesn't account for the fact that the tails of the distribution, could be very large. So there could be a few, billionaires in there that would affect the mean, but wouldn't affect the median. At the same time, there can be a lot of people at the far other end of the extreme that are much lower that will affect the mean in a more pronounced way than the median. So, with the median, if the rich get richer and or the poor get poorer, the median won't change because it's already the lowest amount, it's just getting lower. Whereas with the mean, that would be reflected. And so to the extent you're concerned about increasing inequality, the mean is a more appropriate measure.
And which measure did you use?
We use the mean, as we explained 2 weeks ago. I should also say the difference between mean and median is not a huge number. And that's, with large populations, that's what you would expect, that it converges. The mean is higher than the median, but it does include that additional information about not just how many people are richer, but how much richer they are getting.
So I guess,
Oh,
for,
yeah, there was another concern I just mentioned, and just like, that's what I get for doing them in reverse order.
well, you had talked about there being um, the mean versus median and the other concern.
Oh, after versus total income versus after-tax income.
Okay, yes, the
Yeah.
after tax.
Well, again, I think total income is a more reliable measure of all the things you could do. The fact that some of that may be paid in taxes doesn't mean you shouldn't be getting some of that benefit from the Crown. Total income also includes transfer programs. So to the extent that you're getting benefits, say from the Crown, that would be included in total income, but I wouldn't typically think of as being included in after-tax income. So again, I just think it's a more holistic measure. If we were to take total versus after-tax, would lower the numbers for both, but the gap itself wouldn't change all that much.
Thank you. And then over at page 311 or slide 311, I guess you have a summary of the income gap. Now it's noted 1870, 2019, but I guess you could also, from your testimony, it could be 1850 to 1870, no income gap assumed, in 1870 to 2019. This is the result.
That's right. It says 1870 to 2019 because I assumed 0 for 1850 to 1869, I guess.
Yes.
Yeah.
Okay.
You can't count 1870 twice. That's
Yes,
the only point
got
I
it.
was making.
Not being an economist, I might try and do that.
No. Okay. So this table summarizes and basically taking the math from the prior slides about how big is the gap. And this is then just multiplying it by the population estimates. There were 2 sets of population estimates in Dr. Bignami's report that I used. One called the low growth scenario, one called the high growth scenario. The low growth scenario results are on the left. That's a nominal gap of 5.5 billion. At band trust rates, that's 34.4 billion. And at the 60/40 equity to debt rate, that's 193.6 billion. Okay, that's the left.
Yeah.
On the right, we have the high growth scenario. And the results there, so I'm reading bottom to top just because we talk about nominals usually.
Yes.
Is 5.3 billion, 29.4 billion at band trust rates, and 153.0 billion at the 60/40 equity to debt blend.
And just if you can tell us, maybe you can't, but I just note that the low growth scenario ends up with a higher number than the high growth scenario.
Yeah.
Did you look, were you able to appreciate why that was the case, or?
Sure. So part of the issue is backcasting is the right word, but going backward, and there's good population data now. At some period back in time, you have to make an assumption about the population growth rate. Now, if you know the population today, if you assume a high growth rate happened in the past, you're going to end up with a lower population back in the past, right? Because if it grew a lot, that means it had to start from a low number because we fixed the endpoint. Whereas if it grows at a low rate, it must have started at a higher population because it had, we know the end result. We know the population today. You have to reach there. You can either go on a low growth path or a high growth path. If you go on a high growth path, that means there were fewer people here 150 years ago. Fewer people translates to a smaller income gap. So that's just why, low, high, up is down sort of thing.
Okay, so it's an inverse relationship once again.
Yes.
All of which now brings us to the last slide of Exhibit G, as in George, which is the
Yes.
3 new slides brought up today. And that's, I guess, really, it replaces slide 313
That's right.
on Exhibit F.
After that big slide that said conclusions, there was just one slide.
Yes.
So we'll use the updated numbers. The next slide, if we don't mind.
Yeah.
Oh,
There
okay,
it
here we
is.
go, sorry. Must have been a lag, sorry. Right, so to rewind to last week, there were 3 questions. I was kind of asked three things for me to study. The first, what is the measure of net Crown resource revenues in the treaty territory? And for that, I look at direct Crown resource revenues and expenses that collect, regulate, and support those revenues. That's the first row of this table on slide 313.1. I guess I should read through the numbers. That's 1.043 billion in nominal terms, 8.896 billion at Professors Beaudoin and Smart's preferred long-term bond rate, 9.876 billion at my alternative band trust account rates, and 56.895 billion at my preferred 60-40 equity to debt approach. That was job 1. That was all of last week.
And job 2 was rents.
It was rents, as we talked about earlier this morning, and Professor Stiglitz laid the framework for 2 weeks ago. And those results were 3.586 billion in nominal terms, 27.847 billion at Professor Beaudoin and Smart's long-term bond rate, 29.280 billion at my alternative band trust account rates, and 126.285 billion at my preferred 60-40 approach. Then the third task I had, the third ask, was the income gap analysis.
Now, on slide 313, you just use the low growth scenario, which is the higher of the 2 numbers.
That's
Just for illustration purposes.
That's correct. The slide we looked at just before this one had low and high. I think that was slide 311, but on slide 313.1, I just have the low growth. And again, the results there are 5.545 billion in nominal terms, 31.089 billion at Professor Beaudoin and Smart's long-term bond rate, 34.405 billion at my alternative band trust account rates, and 193.581 billion at my preferred 60-40 rates. All of those are present values using data through 2019, expressed in March 31, 2020 dollars.
Thank you.
So if one used the either the NCRR approach or the economic rents approach, neither would close the income gap,
That's correct.
or which you say is a proxy for the wealth gap,
That's right. And
a
that's
usable proxy.
right, a usable proxy for the wealth gap. And that's, because we've had these in the same way the rents and NCRRs have compounded over time, the wealth gap has also, compounded over time. We saw those charts, the orange,
But I said, but you use the income gap.
the income gap as well. Sorry, the income gap has also compounded over time. If we go back to that figure with the green and orange lines, the green line has been growing a lot faster than the orange line. So there was a gap to start with, 1870, I think, when the data started, and that has grown larger over time. Does that make sense?
Yep.
Okay,
Thank you.
sorry. Income gap.
So with my friend's agreement, I would ask that Exhibit F and Exhibit G be converted to numbered exhibits 11 and 12 in series. They indicated they wanted to wait until Mr. Hutchings completed his direct before they indicated whether they would agree with this or not. And so we're at that end. And I would ask them to agree, or if not agreeing, then I guess we would proceed by way of argument.
Any problems? Thank you. Thank you very much. Mr. Schachter, would you ask Mr. Hutchings for his comment on waiving copyright?
Oh, yes. Okay. I apologize. Mr. Hutchings, as part of this process, it's being televised and a record is being kept. And are you prepared to waive your any copyright in your reports and in your testimony?
Yes.
Thank you. Thank you.
And by agreement, then Exhibit F would be Exhibit 11, I believe, is the next one. And Exhibit G would become Exhibit 12.
So I will ask the registrar then to assign the names that we gave to exhibits F and G to exhibits 12. And it could be annotated that were formerly exhibits F and G
Yes.
to 11 and 12, yes.
And I believe, Mr. Hutchings, those are the questions I have for you. The court or Mr. Gover might have a few questions. It is now 12:10, and I leave it for Mr. Gover and the court and my friends to discuss whether we should break now or, and of course, with the court's input. It depends how long he's going to be, I guess.
Right. Thank you.
Of any assistance, Your Honor, I anticipate being between 5 and 7 minutes.
All right. Well, then all power rests in the hands of the reporter. You're good. We'll continue.
Thank you very much. And Mr. Hutchings, as you know, I act for the so-called group of 7. They are added party plaintiffs in this action. And I'm going to take you back to 2 areas. The first of them relates to the forestry expenses that were attributed by Professors Bodway and Smart. And of
Okay.
course, last Tuesday and again this morning, you have spoken to some extent about Professors Bodway and Smart's approach to forestry expenses, especially since 1950 or so. Is that right?
Yes.
And your primary disagreement with their approach is that, in your view, they have attributed forestry expenses that support various benefits, such as indirect Crown revenues, other economic benefits, and non-economic benefits, all to direct Crown revenues from the forestry sector. Is that a fair summary?
Yes, I believe that's part of my critique. I think more generally, it's that there's, in my opinion, a lack of detail in the data, starting in the mid-40s, that make an attribution analysis, should we say, difficult, unreliable. That's why I took a different approach. A result, though, of trying to pursue such an analysis is you get a result like Professors Bodway and Smart's, where the expenses are being allocated to only one portion of the benefits. So I might call this is more of the symptom of the bigger problem.
All right. And you used a term aggregation.
Yes.
Is that right? And what did you mean by that?
Oh, what I mean is that in any one line item in the public accounts, it might contain activities that are relevant, irrelevant, partially relevant, and we lack the data to split them apart. So in that cost allocation exercise, we just have this big undifferentiated basket of costs that we know support all these things, and we lack a reliable way of separating them. So that's what I mean by it is too aggregated to do the analysis.
With Ms. Lewis's help, we're going to go to slide 205 from what is now Exhibit 11.
Those are my slides.
And here we have forestry related expenses 1946 to 2019. And I want to spend some more time on expenses that Professor Bodway and Professor Smart include in the relevant category that you've just alluded to.
Okay.
With that in mind, could we go to slides 168 and 169 of Exhibit 11? And these are the 1951 and 1961 Ontario Public Accounts snapshots. that you showed us as examples from Ontario's public accounts that demonstrated the issues that arose after 1945 with aggregated expense line items. Is that correct, sir?
That's correct.
And both of these examples are snapshots from the Ontario public accounts of expenses for the Department of Lands and Forests, as it was then known. Is that right?
That's correct.
Now, on each account, and it takes a bit of study, but on each account, there is a large line item for basic organization, district offices, including provincial parks, etc. And that's toward the lower left of what we have depicted on this slide, which is slide 168. Is that correct?
That's correct. It's the number with the red box around it in the bottom
Right.
left. If you go further left, you get the label you just read.
And can you help us to understand what that expense line covers, please?
Sure. So it covers, after an accounting change at the department, as the name might suggest, all the activities at the district offices. And you might say, well, what activities are the district offices of the Department of Lands and Forests undertaking? So it's broken apart here into three buckets: salaries, traveling expenses, maintenance, and operating. Those don't really give us any better indication of what is happening, except there are people doing work, they're being paid a salary. But what is it supporting in terms of a direct crown resource revenue? Well, it could be supporting the stumpage and forestry activities. Part of it's no doubt supporting fish and wildlife activities. Those aren't reported separately. Part of it's supporting the parks, as it says there in the name. And you might recall, for both provincial parks and fish and wildlife, there's agreement between myself and Ontario's experts that we don't count any direct crown resource revenue. There are conservation authorities that have appeared in other time periods that don't appear in this year. Costs supporting those would be included in basic organization. And that's some big ticket items. There may well be others, but my point is, I can't, as between them, I don't have a reliable basis to separate them.
Or to ask the question, are those expenses broken down into any more detail in the public accounts?
No, not in the public accounts.
And if we go to slide 169, which is 10 years later, here we have the snapshot for 1961 from the Ontario public accounts. A little bit of leading to get to the point, but is there any difference here in what we see?
No.
What information does that give us about whether these sub-item expenses are relevant or irrelevant expenses?
It doesn't give us any information about how to separate the relevant from the irrelevant.
Can you tell us, in their analysis, how did Professors Bodway and Smart treat these expense line items? That is, were they, to use the terms you introduced earlier, fully included, fully excluded, or partially included?
For basic organization from 1943 to, I believe, 1963 or 64, they partially include them. I think they include about 80% of basic organization expenses.
And given that this is for the Department of Lands and Forests, how would these included expenses in Bodway and Smart's analysis relate to their forestry expenses that you've discussed earlier?
Sorry, I don't
So
quite understand the
let me ask
question.
it
Yeah,
again.
okay.
How would the fact that these are included expenses in their analysis relate to their overall forestry expenses?
They would be included in those overall forestry expenses.
Would they increase or decrease the forestry expenses in their analysis?
By including 80% of them, they increase the total expenses.
Right. Thank you. And finally, other issues in the approach taken by Professors Bodway and Smart that you touched on in your testimony included what you've identified as some errors. Is that correct?
Yes,
And you've referred to their inclusion of fish and wildlife expenses. Is that right? In some
yes, in
instances?
some years from 1997 to 2011, I believe.
And you've also pointed to some double counting of certain expense items. Is that correct, sir?
That's correct.
Now, Mr. Schachter has asked you how you were able to identify those errors. You recall that, Mr. Hutchings?
Yes,
And you responded that you did not do a line-by-line review of their work papers. Did I understand that correctly?
that's correct.
All right. Thank you very much, Mr. Hutchings. Those are my questions.
Thank you, sir. This would be a good time for a break, I take it.
Yes, I would think so, yes.
Uh,
Ontario's up, I believe.
All right, shall we take lunch? I have, it's about, is it 12:15, 12:20? What, 21, 20, what, first for the reporter? What suits you, an hour and a half? All right, we'll take an hour and a half, which brings us to 1:20, 1:40. Is that good? 1:40? Is that good for you?
Yes.
When you're back on your feet, Mr. Hong, would you let me know how you think, as starting today at 1:40, how you think that aligns with the time that you require? Thank you. All right. Thank you very much. And we'll break now to 1:40.
This court will recess until 1:40. Thank you.